This is Cycle Analysis Workshop Addendum number 5, Analyzing Market Conditions, Combining Daily and Intraday Cycle Patterns. We're going to also review the principle of synchronicity and summation briefly because that's so integral to this type of analysis. This is actually really part 2 of Module 17. So I really think you should go back and watch Mod 17 before or after you look at this video. You might want to do both and watch this again. I think it's going to be quite valuable. And the reason that I decided to do this was because over time, now and then, I show the 2-hour S&P cycle chart, and a lot of people have interest in that. And I wanted to show basically what I thought the best way to use that information was, and it's not something we show all the time. So if I brought this to you, then maybe you'd be able to develop it on your own because I don't keep it updated all the time. And it's just, imagine if I had to do this for all of the different indexes and futures we do, it would be absolutely crazy. So someday we may have it automated, but at the moment now we do it manually. So that's what I wanted to do, is show you how to look at this and potentially how to do it manually. Some things that I said in Addendum 17 that are worth repeating are that the intraday cycle patterns tend to be erratic, more erratic than you see in the longer term daily, weekly, monthly cycle patterns. It's like the further you go out, the longer the duration, the smoother those patterns are, and the certainly more value. I think that the best use of the intraday cycle patterns are for entry and exit. So in other words, using the longer term, and in this case longer term being daily, as the momentum condition or the trend conditions, and then using the information off the 2-hour chart or potentially a 4-hour chart for your entry and exits. And I think that's really the best way to use this combination of charts. Again, multiple time frame analysis. Often these charts are out of phase. In other words, the daily chart won't exactly line up with what we're seeing on the intraday. And the difference is, of course, that the intraday is minutes and it can change quickly, while the longer one, the daily, is smoother. So they get out of phase, and that's an important thing to recognize when you're using this information. And that's why when I did the module number 17, I was pretty clear saying that I didn't think that this was the best way that you could use cycle analysis. Though what I think I'm going to show you now, if you really wanted to use intraday patterns, is a very good way to use the information for both. So again, we're going to use daily and intraday together in order to get this the best information, I think. And you'll see what I'm looking at and see if you like it or not. All right, so what we'll do first is review the principle of summation. This is one of the most basic parts of cycle analysis in Hurst 8 principles. And what this says is that price waves, which combine to produce price movements, do so by a process of simple addition. That is, it's so simple that almost it's too simple to look at. Now, let's say that this right over here is the cycle brackets that we show you. It's just not drawn with curves, it's drawn with sticks. Then you could see that this would be a neutral condition, up half the time, down half the time. And you can see that up half the time, down half the time, each of these a completed cycle. But when you add in a trend, as you can see, what that equals is this being pushed into that trend, and you get this right over here. So in other words, an uptrend will give you a longer upside move and a shorter downside move, hence a translation that is positive. Again, a longer move and a shorter move right over here. So this plus this equals this. Here's how it shows up in actuality on a chart. And you can see this cycle here and this cycle here being pushed up by upward energies, probably coming from the next longer time duration. And each of these going to a higher price level. cycle. Then when you get this cycle right over here failing to make this high, it says the energies have changed and then begins to come down, and when you break this level here, it warns you that it's going to complete the time frame on the downside. And yes, this cycle here made a left shoulder, this made the head, this made the right shoulder. The right shoulder is formed because the upside energy is gone. And then you get a neckline that's built right in here, and that's why the cycle energies form these chart patterns. In this case, this might have very well been a triangle or a flag or something like that right in here. The same thing for this. This was probably a flag. This was probably a flag. So that's how you get these patterns and the information off the pattern. So off of this very basic principle of summation, there's a wealth of information that you can get about the market conditions. And we talk about this all the time. And I don't repeat when I look at the charts that this is based on the principle of summation, but those of you that have taken the workshop understand that, hopefully. And if not, I really encourage you to go through the whole workshop again. So that's the principle of summation. Very, very basic, but so important. The next one that we're going to look at is the principle of synchronicity, which really works well with the principle of harmonicity. Also, this is an old chart that I stole from the previous time that we looked at this. Principle of synchronicity. Waves in price movement are phased as to cause simultaneous troughs. This is also an aspect of the principle of harmonicity. When troughs of longer cycles normally coinciding with troughs of shorter cycles are related. So in other words, this is a harmonic family in here, and the cycles inside of it are related. You see that right in here. Now you can see there is a dominant cycle. That's what we refer to that, and then the intermediate, and then the minor cycle right there. Most of our charts have 2 or 3 cycle brackets on them. Remember, cycle brackets are not the cycles. The cycles are how they resolve themselves up in the actual price action. So this is that whole big dominant cycle there in the blue. This one right over here in green is the minor cycle, and you can see in here that that minor cycle came down right over here. It was still a positive translation. As you can see, the expectation would be that it would move to a new high. However, it failed in here and then broke this low, and that told you that this intermediate cycle was very likely to have energies pointing to the downside. And then you had the minor cycle formations 1, 2, 3, and 4. You can see that very clearly. And what this did was give you a negative cycle and a negative cycle. And all of this synchronicity came as these cycles that are related had simultaneous troughs. And that's why we talk about when the energies are positive, you will get all of these moving up together right there. When the energies are negative, you will get all 3 moving down together. And in this case, it was very clear once it broke this level here that all 3 of them were moving down together, and then you get into this selling or capitulation stage where the simultaneous troughs are created or dominated really by the longer cycle, the longer term cycle in there. And you could see how they all 3 moved up together in here, and the minor cycle formed here. And these stars in here that I put are just a little different way to show you when one cycle is making a trough, or 2 cycles are making a trough, or all 3 are making a trough. And that's really the important lesson in here in the principle of synchronicity. So I wanted to review these for you so that you could get a sense for, wow, I'm looking at that, and now I see what Slim is talking about, or our whole team, which are all experts in psychoanalysis, using these same principles, don't really say the words, don't really teach it, and go into this kind of depth. That's why we have a psychoanalysis workshop, which you so wisely decided to invest in. So that's the principle of synchronicity and also the principle of summation. So now we're going to look at analyzing market conditions, combining daily and intraday cycle information.